The IRS just released the 2026 tax brackets, and they directly impact taxation on your Social Security, Roth conversion, investment income, and more. Now, without a clear plan before the changes hit, you could hand the IRS hundreds, even thousands more taxes than necessary. So, this video breaks down exactly what's changing using real before and after scenarios built for near retirees and those currently retired. Let's waste no time and dive in. So, what's changing in 2026? First, let's start with the increase in the standard deduction, which is the deduction most retirees take. Here's how it looks in 2025. Single taxpayers get a deduction of $15,750, married couples $31,500, and head of household $23,625. Compared to 2026, the amounts are increasing for single taxpayers to $16,100, for married $32,200, and for head of household $24,150. That's around a 2.5% bump. But for those retirees age 65 and up, there is an additional deduction. In 2025, for those single or head of household, they get an additional $2,000 deduction per qualifying taxpayer. For married filing jointly, married filing separately, or surviving spouse, it's $1,600 per qualifying spouse. But in 2026, those amounts are getting a $50 increase. For those single or head of household, you get an additional $2,050 deduction per qualifying taxpayer. For married filing jointly, married filing separately, or surviving spouse, it's $1,650 per qualifying spouse. So, to put this all together as an example, a married couple over age 65 would have a total deduction of $32,200 plus $1,650 for each, a grand total deduction of $35,500. So, how much will these increases actually save you? Well, compared to 2025, their grand total deduction increases by about $800. Even at a 22% tax rate, this is only going to save you about $176 in federal tax. So in 2026, the standard deduction increases are certainly welcome, but nothing that's going to significantly change your tax situation. But let's move on to the updates that are. Now, most people take the standard deduction, but if you're a tax filer who itemizes, which is common for those in high income tax states, there's one more change you'll want to know. The state and local tax deduction cap has increased significantly. Now, before the latest legislation, this cap was $10,000 per year, limiting many high income earners in high tax states. But now it's expanded to $40,000 for single, married, and head of household retirees. There is a phase out once your modified adjusted gross income exceeds $500,000 for those retirees, and you'll go back to the basic $10,000 cap once your modified adjusted gross income reaches $600,000. But this means if you have large state income taxes or property taxes plus other deductions like mortgage interest, medical expenses, or charitable giving, you're far more likely to benefit from itemizing now. Now, keep in mind, you only benefit from itemizing if your total deductions exceed the standard deduction. And with the standard deduction increasing, it's worth modeling your 26 return both ways. For some households, especially in high tax states, this makes itemizing viable again. It could add thousands back to your refund or reduce what you owe. But there is another big adjustment that will dramatically change taxes for seniors. There's a new senior deduction rolling out from 2025 to 2028. On the surface, it sounds like a win because it's an extra $6,000 deduction per person over age 65. But before you start celebrating, let's look at the fine print. So first, let's talk about the good. This deduction applies even if you itemize your deductions, and it stacks on top of the existing additional age 65 and up deduction we talked about a moment ago. For a lot of households, this could add up to a significant write-off and where the tax savings really start to stack up. For example, a married couple, both over age 65, they could have deductions of $35,500 for the standard deduction and over age 65 additional deduction, plus $12,000 in the enhanced senior deduction, totaling a whopping $47,500 in deductions. But here comes the catch. It starts phasing out relatively fast, especially for those in high cost of living areas with a good amount of reportable income. If you're single and your modified adjusted gross income is over 75,000, you lose 6 cents of the deduction for every $1 over that line. That means the $6,000 deduction will be fully lost if your modified adjusted gross income reaches 175,000. For a married couple, that phase out starts at 150,000 and is fully gone by 250,000. This can be especially painful for married couples because, again, each person over age 65 gets 6,000, which means if you're not careful, a full $12,000 benefit for a married couple could be lost. So the deduction is big, but it vanishes if you're not careful. This is especially important when looking at things like Roth conversions and a new consideration for those looking at smart tax planning in retirement. If those conversions push you over the phase-out line, you're trading today's deduction. This means careful planning for Roth conversions are even more important than ever. Now, the ordinary income tax brackets are also increasing in 2026, and here's what they look like. For single filers, 10% up to $12,400, 12% up to $50,400, 22% up to $105,700. And as a reminder, since it's such a common misconception, here in America, we have what's called a progressive tax system, which means your income is taxed at different levels. I like to explain it like buckets filling up, right? So once the smaller bucket is filled up, you move on to the next bucket. So a person with 100,000 of income would pay 10% on 12,400, 12% on 38,000, and 22% on 49,600. Going back to the bracket updates, you'll pay 24% up to $202,000, 32% up to about $256,000, 35% up to about $641,000, and 37% beyond that. Now that's for the single filers. For married filing jointly, the amounts in each bracket are expanded. Those amounts are 10% up to $24,800, 12% up to about $101,000, 22% to around $211,000, 24% to about $404,000, 32% up to about $512,000, 35% up to about $769,000, and 37% beyond that. Now, if you're wondering how this differs from 2025, you should know that the bracket percentages have stayed the same as 2025, but the amount of income in each bracket has increased by around 3% averaged across the board. Here's a quick example. The 12% bracket for a married couple in 2025 was $96,950. In 2026, the 12% bracket is $100,800. This means you can squeeze an extra $3,850 in the 12% bracket in 2026 before moving into the 22% bracket, which is 10% higher. So this means this higher bracket threshold would save you around $385 in taxes. Now that might sound modest, but remember, we have a progressive tax system and each bracket in 2026 is higher than the last, so the benefits stack up the more you make. But these are just the ordinary income brackets that impact things like wages, IRA distributions, short-term capital gains, and taxable interest. There's a whole separate bracket that applies to long-term capital gains. Now, most people think it sounds too good to be true, which is to pay 0% tax on your investment gains, but for many retirees, it's still very possible if you understand these special capital gains brackets. Capital gains are created when you sell an investment within, let's just say, a brokerage account. Let's say you bought a stock for $5 and now it's worth $12. That's a gain of $7. Now, if you sold the investment less than a year from when you first bought that investment, that $7 would be considered a short-term capital gain, and it would be taxed at ordinary income rates. However, if you hold the investment for greater than a year before you sold, then that $7 would be considered a long-term capital gain, which gives you access to the special capital gains bracket. In 2026, for single filers, for you to realize long-term capital gains and stay in the 0% bracket, it's up to $49,450, 15% up to $545,500, and 20% above that. For married filing jointly, it's 0% up to $98,900, 15% up to $613,700, and 20% above that. And for head of household, it's 0% up to $66,200, 15% up to $579,600, and 20% beyond that. But here's the trap. That income threshold includes your ordinary income. Things like wages, IRA distributions, and interest, they all count. So if your ordinary income pushes you past 98,900, your long-term capital gains shift into the 15% bracket. Because remember, the opposite isn't true, and this is important. Long-term capital gains don't push you into higher ordinary income brackets, but ordinary income can push your gains out of that 0% zone. Also, don't forget about state taxes. Just because the federal rate is 0% doesn't mean your state agrees. Many states tax capital gains the same as ordinary income. So, what can you do? First, know your taxable income limits and use tools or work with a professional to model how much gain you can recognize without triggering the 15% bracket. Secondly, use timing to your advantage. Spreading out the gains across multiple years can help you stay within that 0% window. And third, use tax loss harvesting to offset gains as needed. Ordinary income can push you into higher capital gains brackets, but the reverse isn't true, and many retirees miss this. Now, even though there are a lot of changes in 2026 and many brackets have increased, not everything in our tax code gets adjusted. And that's where some of the sneakiest taxes hide. So first is the net investment income tax. This is a 3.8% surcharge on investment income once your modified adjusted gross income exceeds $250,000 as a couple. That threshold has not changed since 2013, and it's not indexed for inflation, which means many more people will fall into it every single year simply because of normal income growth. Second is the taxation on Social Security benefits. Once your provisional income exceeds $25,000 as an individual or $32,000 as a couple, your Social Security gets taxed. You go over $34,000 as an individual or $44,000 as a couple, and up to 85% of your benefits are taxable. Again, these thresholds are frozen and have been so for decades. These unindexed lines quickly eat away at your income. So the big planning tip here is to consider other options. Consider using qualified charitable distributions if you're over age 70 and a half, or time your income strategically in low income years. These hidden taxes behave like a stealth tax increase, and these hidden taxes quietly eat into retirement income because they're not indexed for inflation, making long-term planning even more critical. Lastly, let's talk about one of the most overlooked tax-style penalties in retirement, IRMAA. IRMAA is the Medicare premium surcharge you pay if your income exceeds certain thresholds. And here's the kicker that trips up most people. Your 2026 Medicare premiums are based on your 2024 income. That's a 2-year look back. The last time I checked in mid-October, these numbers weren't official just yet, but from many reliable sources, here is the expectation, and it should be very close. So for example, as a single filer, if your modified adjusted gross income was over $109,000 in 2024, then you'll pay a premium surcharge for both Part B and Part D. As a married couple, if your modified adjusted gross income is over $218,000, you'll pay a surcharge as well. And those surcharges go up significantly with more income. The important thing to be aware of is that these brackets act like a cliff. You go over a bracket by just $1 and you'll owe premiums at the next level. It's not progressive like tax brackets, so pay careful attention to avoid overpaying in premiums. That's why IRMAA planning needs to be a part of any tax strategy. So you want to use staggered Roth conversions or model your modified adjusted gross income and talk with a planner who understands these cliffs. In 2026, the base Medicare premium Part B is expected to be around $206 per month. So adding any more premium surcharges on top of this is just insult to injury. Now that we've covered how the 2026 tax law changes could quietly cost you thousands more without a plan, what if you could flip the equation and pay zero tax on 6 figures of income even without a Roth IRA? So watch this next video where I walk you through a real case study of how we helped a couple keep $120,000 of retirement income completely tax-free using the updated rules. I'll see you over in that video right now.